Last day of the month today. I was speaking with Henry Jennings from BBY earlier, and he thinks the old adage of sell in May and go away really did hold true this month. What do you think?
Certainly did in the Australian market. The fourth straight year that the saying sell in May and go away has held true. It actually hasn't really around the globe. We've seen US markets and European markets gain over the month. S&P 500's up around 3.5%, while the ASX 200 here over the period of May has dropped 5%. And that's really been led by the yield and the yielding and bank stocks. If we have a look over the past 4 years, it's held true across the Australian market as well. 2010, the market dropped around 7%, 2011, 3%, and last year, again, another 7% drop in May. And if we look over the past 20 years on the ASX 200, May's actually been the second worst performing month. It's averaged a loss of around 0.8% over the past 20 years. So looking across the sectors, the financials were not surprisingly the worst. That sector off over 9%, with the big four banks the big weight in that sector. The big four banks averaged a loss of around 12.5% over May. This was followed by other defensives such as staples, utilities and telecoms, which all underperformed the broader market. The best was the IT sector. That was up 7%, and that was largely driven by Computershare, which was up around 13% for the month of May. But then we saw the resources outperform as well. Energy was the next best performer, while materials also strong across the month. So the theme was clear across May. It was a shift from yield and defensives, resources outperforming in a relative sense. It really has been macro themes though, drivers from the US in terms of tapering off of quantitative easing, but more importantly, that big slide in the Aussie dollar. The Aussie dollar's fallen around 7 US cents over the month of May, and really that's been a big driver of the sell-off of the banks in particular.
Tim, US markets overnight really seem to shrug off some of that economic data, with the GDP figures being revised down worse than expected, and that bigger than expected jump in weekly jobless claims. Is this all to do with the QE story and the fact that it means perhaps we'll see those stimulus measures extended for a while longer?
Yeah, it's almost illogical, isn't it? I mean, it's all about the economic data at the moment. US GDP last night coming in worse than expected, and it's a bit of a catch-22 for markets at the moment. Stronger economic growth is good for markets, but at the same time, stronger economic growth means the chances of quantitative easing being taken away from the market sooner than what they were expecting. So if we look at the first quarter GDP figures, slightly missing expectations, coming in at 2.4% at an annualised rate, and the reaction in the market was for the S&P 500 to gain around 0.4%. I think this demonstrates the short-term focus in the market at the moment and how obsessed the market is with quantitative easing, because the biggest driver of longer-term gains for the US market will be a strong recovery in the US economy, lower unemployment, better consumer spending, better corporate profitability. This is going to be a big driver of US markets in the longer run. Quantitative easing isn't going to drive outperformance in the long run, so removal of quantitative easing really in the long term shouldn't be feared. But the fact that the market is so short-term focused at the moment is seeing the volatility within the market, and also seeing the market fearing it being taken away.
And Tim, what are you expecting on the local market today? We had a pretty good night in terms of the performance of commodities, and of course that good lead from both Europe and the US. IG tipping an opening gain of about 0.4%. What do you think?
Yeah, it looks like we will be opening higher. We've got good leads from offshore markets. Commodity prices were mostly higher overnight. Gold saw a good bounce, so I'd expect to see the gold miners put in a strong performance today. Copper and base metals were also doing better after that, after some of the data that was released around the globe. Oil also trading higher. So I think the market yesterday, very much the materials were weighed down by the accelerating losses in the iron ore price, and disappointingly we've seen it drop another 1% overnight. So it'll be interesting to see the moves in the materials overnight. But I think on the ASX 200, it's been important that we've found support around that 4,900 level. 4,900 has been was the closing dip that we saw in the correction in early April. So we've found support there, but it's also a level where we're probably going to find some yield support in the market. We've seen the banks sold off quite heavily, and that's pushed their dividend yields back up to around that 6% level average across the big four banks. And I think this will be probably a pretty good support level for the prices of the banks, because I think probably the banks sell-off at the moment has probably run its course. So I think they'll probably find some support here. The slide in the Aussie dollar has been hurting the banks. We've seen the Aussie dollar now gain both yesterday after those capex numbers and gaining overnight in offshore trade. So maybe a little bit of support back in the banks today.
All right, Tim Piper from Bell Direct, great to get your insight as always. Thanks a lot.